See, when you are buying a stock, it is very important to know uh, relatively where it is placed compared to the 52-week high and the 52-week low. So, for example, if a stock is, let's say, 200% above the 52-week low and it is very close to the 52-week high, what does that mean? It means that probably you are buying the stock late. During that 100% or 200% advance, the stock might have created some 4 or 5 basis in between, right? So you are probably buying late. So it is very important to understand where are we with respect to the 52-week high and 52-week low. That is exactly why MarketSmith gives you this data on the chart itself. So let me open a chart for you, and we'll also look at trading view as well. So let's look at CAMS. So if you notice, see here they mention OH and OL. OH means off the high and OL means off the low, right? Off the high means 52-week high, off the low means 52-week low. Now, first we need to understand what is 52-week high and low. So let's go to CAMS. So have a look at this. Okay. Let me remove all this. Okay. Have a look at this. So currently we are in 4th of December. So if you go back to, let me draw a line here. Let me draw a vertical line here. So see, I have drawn a vertical line here. Let's go back to 4 December 2023. 4 December 2023. Yeah. So I will draw another line here. So see, you see these two yellow lines. In between that's the 52-week period. Okay. From today going back, let's say 1 year. So in between these two, what's the high? Okay. So the high of this candle is the 52-week high. So let me mark the high of that candle. So roughly somewhere here. So let me draw that. Wait. Yes, I have drawn that high. So let us give this yellow color. So it highlights. Let's draw the 52-week low. Where is the 52-week low? Between these two yellow lines, vertical yellow lines, what's the lowest price? So probably this one, the low of this green candle. Okay. So let's draw a yellow line there. So now you see this is the 52-week period from this yellow to this yellow. And in between you have the high and low. So off the high means what? So you have to go to this yellow line and measure the distance till the closing price. So from this yellow line till the closing price, how much is the distance? 1.37, 1.49 roughly. So basically, it's off 1.49% below the 52-week high. Okay, it's written minus here. Okay. By the way, this number is always going to be minus because as the price creates newer and newer highs, the exact closing price or the current price will be below that high. So this number is going to be minus always. Okay. So off the high. So you have to measure from the top to bottom, not from the closing price to the 52-week high. You have to measure from 52-week high to the closing price. So from top to bottom. But 52-week low, you have to measure from the low to the high. Okay. So let's measure that distance. So 52-week low from this, okay, from this yellow line till this closing price, 95.62. See 95.84. So that's the distance. Okay. So basically it tells you where your current price is with respect to 52-week high and 52-week low. Let's look at some more examples. Okay, so let's look at Mazgaon Docks. So you see it's 17% below the high and 170% above the low. So let's go to Mazgaon Dock. So this is the high, right? So let's measure the distance from this high till this closing price. It's 17%. As you can see here, 17%. And 170% from the low. So what's the low? So from December, somewhere here. Yeah, this is the low. This is the low. Okay. So I take this low somewhere here and measure the distance. See, till the current price, 166%, 167%. So 170%. This number is changing because the market is live right now. Okay. But you understand what I'm trying to say? When you are measuring OH, you have to measure from the top to the closing price. When you are measuring OL, you have to measure from the bottom towards the closing price. Now, why is this important? Okay, let's look at some more examples. So you have divis. So it is off 0.41%, which means it is very near to the 52-week high, 86% above the low. So as you can see, during 1 year, it has traveled a distance of 86% from the low. So you're probably buying late. You're probably buying the stock late. Now, sometimes it's true that you're buying late, but sometimes it's not true that you're buying late because during that 1 year period, if the previous base gets broken, if the previous base low gets broken, then the base will reset. Okay. So you might be in early stage. So for example, see, this is base number two, in spite of the fact that the stock has traveled 86% from the 52-week low. You understand what I'm saying? So let's look at another example. Have a look at this, 200% above the 52-week low and 0.22% below the 52-week high. So if you check this, this is the third base in that ride. So by the time, as I said earlier, by the time the stock goes from the base number one to base number three, it has probably given you a triple digit return. And by the time it goes from three to base four or five, it probably given you another triple digit return. Okay. So by the time a stock goes from base one and two to base five or six, you might expect a high triple digit return, like more than 100%, more than 200%, sometimes 500%. I have seen stocks that have gone up 10 times in 2 to 3 years. Okay, you can check HBL Power Systems, you can check Cochin Shipyard, you can check Mazgaon Dog. These stocks went up like 100% in a matter of 1 or 2 months. You can check their chart. Okay. All of that happens when the stock is already in stage two. Okay. So this low, now let me give you the guideline, what I have understood from Mark Minervini. This number should always be at least 25%. So which means from the low, you want the stock to recover at least 25%. So now you are buying a stock which has already recovered. If this number is less than 25%, that means probably you are trying to do bottom fishing, which is very risky. 25% ensures that the stock has already recovered. It has probably gone into stage two. You have to check the moving averages for that. And if that is the case, if it has gone above 25%, that stock should be under your consideration. This number, the tighter the base on the right side, the smaller this number is going to be, which is fantastic. We want to buy as close as possible to the 52-week high because then there is no overhead supply. The 52-week high could also be the all-time high of the stock price. Okay. So you have to buy closer to this OH. Okay. The smaller that of the high level, the better it is, which means the tighter is the base. It has consolidated nicely. It is near the 52-week high. And once it breaks that 52-week high, a major resistance gets broken and you would not encounter much overhead supply in the shares of the company. So remember this. This number should be as small as possible. The base on the right should be as tight as possible. This number should be minimum 25%. Okay. Maximum it could be anything. This number could be 300%, but you could still be buying the stock in early stage because the previous base low has been broken and the base counting has been reset. So for this to understand what I just said, you have to study my base counting video. Okay. So understand how to interpret these two levels. Okay. I'm keeping this video short. I will not elaborate more. Just remember that this number needs to be more than 25%. This number needs to be as small as possible. Okay. Thank you so much. Have a fantastic day today.